The liquidity didn't disappear, it was withdrawn at a threshold. In the next few minutes, I'll show you three things. What broke in the CME silver futures market when price tested triple digits, why that breakdown represents a structural liquidity failure rather than temporary volatility, and what it forces next across dealer networks, settlement systems, and the broader metals complex. The public story focuses on dealers running out of inventory, premiums spiking, and retail buyers unable to source product at any reasonable markup. That's the visible outcome. The private move is happening in the CME's matching engine, where bid-ask spreads blew out to levels that triggered circuit breakers, market maker obligations were suspended under emergency protocols, and the futures curve inverted so severely that roll costs exceeded the value of maintaining positions. Those three events happened within a 6-hour trading window. That detail changes the interpretation. The lever here is called the Designated Market Maker Exemption Clause, and it allows CME-approved liquidity providers to step back from their obligation to maintain two-sided markets when volatility parameters breach predefined thresholds. When silver tested $100 per ounce, those parameters were breached. The market makers stepped back. The order book went thin. Liquidity vanished at precisely the moment it was needed most. This was not a software glitch. It was a rulebook provision being executed as designed. First, silver broke through $98 on sustained physical buying pressure from institutional accounts taking delivery on March contracts. The move was orderly. Volume was heavy, but not panicked. Then within 40 minutes, price accelerated through $99.50 as algorithmic systems detected the breakout and began executing momentum strategies that compounded the move. The acceleration triggered the first wave of stop-loss orders sitting just above the psychological $100 level. Then, as price touched $100.02, the CME's volatility circuit engaged, halting trading for 2 minutes to allow order flow to stabilize. But that's not the real pressure point. The pressure point is what happened during those 2 minutes. Market makers received notification that volatility parameters had been breached and their obligation to provide liquidity was temporarily suspended. When trading resumed, the bid-ask spread that had been 12 cents wide before the halt reopened at $4.70 wide. That is not a spread. That is a void. Then, dealers who had been sourcing metal through the futures market to fulfill retail orders found themselves unable to execute at any price that allowed them to maintain margin. Their hedge positions, which were supposed to lock in cost and allow them to quote firm retail prices, became unhedgeable. The futures market was no longer functioning as a price discovery mechanism. It was functioning as a volatility amplifier. Then, within 90 minutes, 3 of the largest bullion dealers in North America suspended online ordering and switched their websites to call for pricing mode. That switch is significant. It signals that the dealer no longer trusts the quoted market price to remain stable long enough to fulfill an order. Here's where the incentives show up. Who benefits? Holders of physical silver, who are not forced sellers because their metal is now trading in a market where paper-based price suppression mechanisms have temporarily failed and physical scarcity is setting the clearing price. Large institutional buyers who can access the London OTC market because that market operates outside CME jurisdiction and maintained tighter spreads during the CME liquidity failure. Vault operators because their storage fees are typically calculated as a percentage of metal value, and a $100 silver price doubles their revenue versus $50 silver. Who gets boxed in? Retail dealers who relied on CME futures to hedge inventory because their hedging mechanism disappeared and they are now holding unhedged long positions in a volatile market where customer demand is surging. Small institutional accounts that used silver ETFs as a liquidity vehicle because those ETFs are struggling to source physical metal for creation units and redemption requests are facing delays. Short sellers in the futures market who were betting on mean reversion because the liquidity failure eliminated their ability to cover positions at reasonable cost, and they are now facing margin calls on contracts that cannot be closed without massive slippage. What gets hidden? The identity of the institutional buyers whose delivery demands triggered the initial move through $98. The volume of silver that left COMEX vaults in the 72 hours preceding the liquidity failure. The internal communications between CME risk management and the designated market makers during the 2-minute trading halt. The number of accounts that received margin calls they could not meet. The quantity of contracts that were forcibly liquidated by the clearinghouse when account holders failed to post additional margin within the required time frame. These data points are not published in real time. They show up in weekly commitment of traders reports, monthly vault inventory updates, and quarterly clearinghouse disclosures, all of which lag the actual events by weeks or months. By the time the data is public, the market has moved on and the relevance of the information has decayed. That lag is structural. It is designed to prevent real-time transparency from destabilizing the market further, but it also means that participants are trading blind without knowledge of the forces that are actually driving price. If the CME fails to restore normal liquidity conditions within the next 48 hours, then the futures market loses credibility as the primary pricing mechanism for silver and participants begin migrating to the London OTC market where liquidity remained functional. If dealers remain unable to source product at prices that allow them to maintain retail operations, then the two-tier market that has been developing for months becomes permanent, with institutional buyers accessing wholesale markets while retail buyers face rationing through premium expansion and delivery delays. If registered COMEX inventory continues declining at current rates while open interest remains elevated, then the exchange faces a deliverability crisis where the number of contracts demanding physical settlement exceeds the available metal, forcing either cash settlement against contract terms or an emergency rule change that redefines delivery obligations. These are not speculative outcomes. They are mechanical consequences already being priced into the physical premium structure. The forward curve is now inverted across the entire term structure, meaning every single delivery month out to December is trading below the spot price. That inversion signals that the market expects immediate supply to be tighter than future supply, which contradicts every normal assumption about commodity pricing. Normal commodity markets trade in contango, where future delivery costs more than immediate delivery because of storage costs, insurance, and financing. When a market inverts, it signals that possession now is worth more than possession later, and that valuation only makes sense in a supply crisis. The inversion is not limited to the front month, it extends 18 months forward. That is not a temporary dislocation, that is a structural repricing of the entire silver complex based on the expectation that physical availability will remain constrained regardless of price. The repricing is being driven by behavior changes at the institutional level. Accounts that previously held paper exposure through futures or ETFs are now demanding physical delivery or allocated storage. That shift removes metal from the pool available for future delivery and forces the settlement system to source replacement metal from secondary markets, recycling flows, or new mine production. Mine production is inelastic in the short term. It takes years to bring new capacity online. Recycling flows are limited by the existing stock of recyclable material and the economics of collection and processing. Secondary markets are being drained by the same institutional demand that is stressing the primary market. There is no release valve. The system is closed. Every ounce that exits into allocated storage or private hands is an ounce that cannot be used to settle future contracts. The math is straightforward. COMEX registered inventory stands at approximately 42 million ounces. Open interest in the active contract months represents claims on approximately 370 million ounces. The coverage ratio is 11%. That ratio assumes that only 11% of contract holders will demand delivery. Historically, that assumption held. Delivery rates average between 2 and 5% of open interest. The assumption is breaking. Delivery notices in the March contract are running at 18% of open interest. If that rate holds across subsequent months, the registered inventory will be exhausted by June. The exchange has three options. It can encourage or force cash settlement on contracts that were sold as physically deliverable. That option destroys the integrity of the contract and opens the exchange to legal challenges from participants who entered contracts with the expectation of physical delivery rights. It can source additional metal from outside the COMEX system by expanding eligible vault locations or temporarily allowing non-standard bars to satisfy delivery. That option dilutes the quality standards that give COMEX delivery credibility and creates a two-tier system where some delivered metal is London Good Delivery Standard and some is not. It can raise margins further to reduce open interest by forcing undercapitalized participants out of positions. That option reduces the stress on the delivery system, but also reduces the liquidity and price discovery function that justifies the exchange's existence. All three options have been deployed in previous stress events. All three failed to resolve the underlying problem because the underlying problem is not a temporary surge in delivery demand. It is a permanent shift in participant preference from synthetic to physical exposure. That preference shift is being driven by loss of confidence in the paper market's ability to deliver. The loss of confidence is being driven by observable failures like the liquidity breakdown at $100. The failures are not isolated incidents. They are symptoms of a system operating beyond its designed capacity. The CME silver contract was designed in an era when physical delivery was rare, and the contract functioned primarily as a hedging and speculation vehicle. The design assumptions were that most positions would be rolled or closed, that delivery would remain a small percentage of open interest, and that liquidity providers would maintain continuous two-sided markets except during extreme events. All three assumptions are failing simultaneously. Positions are being held into delivery instead of rolled. Delivery is approaching 20% of open interest instead of 5%. Liquidity providers are stepping back at critical price levels instead of maintaining markets. The system is not adapting. It is breaking. The breaking is visible in the dealer response. When dealers switch to call for pricing mode, they are acknowledging that they can no longer rely on the futures market to provide them with a hedgeable price. They are acknowledging that the paper market and the physical market are no longer trading in alignment. They are acknowledging that the premium required to source physical metal is now so variable and so elevated that they cannot quote a fixed price without exposing themselves to potentially catastrophic losses if the premium widens further before they can source the metal. The premium is no longer a markup, it is a risk adjustment. It reflects the dealer's uncertainty about their ability to source product, their assessment of how much the premium might rise during the time between taking an order and sourcing the metal, and their calculation of how much capital they must commit to inventory in an environment where financing costs are elevated and inventory turnover is slowing because customers are holding metal rather than trading it. The slower turnover means that dealers must carry larger inventories to meet the same volume of customer demand. Larger inventories require more financing. More financing at higher interest rates means higher carrying costs. Higher carrying costs get passed to customers through wider premiums. Wider premiums reduce affordability and slow demand. Slower demand means even slower inventory turnover. The cycle is self-reinforcing. It does not resolve naturally. It resolves through either a collapse in demand that allows inventories to clear or a collapse in supply that forces rationing through price. The market is currently testing which resolution will occur first. If you hold cash, recognize that the purchasing power of that cash relative to monetary metals is now being determined by a market structure that is failing in real time, and the failure is pushing pricing authority from transparent exchanges to opaque dealer networks, where price discovery happens through negotiation rather than open outcry. If you hold risk assets, understand that the correlation between precious metals and equity markets just inverted, because metals are now behaving as monetary assets responding to settlement system stress rather than industrial commodities responding to economic growth expectations. If you rely on a paycheck, track the dealer premium as a real-time measure of monetary system stress, because when dealers cannot source product at prices that allow them to operate, it signals that the gap between official prices and actual transaction prices has become unbridgeable, and that gap always widens before currency crises become visible in official statistics. Don't chase silver at spot plus 50% premiums without confirming that your dealer has metal in hand and can deliver within 72 hours, because premiums at these levels can reverse violently if the CME restores liquidity or if a large holder decides to liquidate into the physical market. Track the CME registered inventory and the delivery notice count weekly, because the ratio between those two numbers tells you whether the exchange is moving toward a resolution or a crisis, and when that ratio exceeds 20% delivery notices against available inventory, the probability of forced cash settlement or rule changes increases exponentially. Assume that quoted spot prices lag physical market reality by a minimum of 4 to 8 hours during volatility events, because the spot price is derived from futures markets that can halt or gap, while physical markets continue trading through dealer networks that do not publish prices in real time. Treat the dealer premium as the signal and the futures price as the lagging indicator, because the futures price reflects where the paper market last traded, while the dealer premium reflects what it actually costs to acquire metal for immediate possession. And possession is the only exposure that matters when settlement systems are failing. Keep optionality by avoiding positions that require you to sell at specific prices on specific timelines, because illiquid markets do not allow clean exits and forced sellers. Illiquid markets are the ones who absorb the maximum loss when liquidity vanishes. The structure that failed at $100 was not a temporary system malfunction. It was the inevitable outcome of a market architecture that prioritized paper liquidity over physical deliverability. The CME silver contract generates revenue for the exchange through transaction fees on contracts that are opened, rolled, and closed. The revenue model depends on high transaction volume. High transaction volume depends on leverage. Leverage depends on margin requirements that are low enough to allow speculators to control large notional positions with small capital outlays. Low margin requirements create systemic risk when markets move violently, because undercapitalized participants cannot meet margin calls and their positions must be liquidated by the clearinghouse. Forced liquidation in a thin market creates feedback loops where selling pressure triggers further price declines that trigger further margin calls that trigger further forced liquidation. The CME's risk management protocols are designed to break that feedback loop by halting trading and allowing market makers to step back when volatility exceeds thresholds. The protocol succeeded in preventing a cascading liquidation event. They failed to preserve the market's core function, which is continuous price discovery and reliable execution. A market that halts at critical price levels and reopens with spreads wide enough to prevent execution is not a functional market. It is a market in name only. The failure at $100 was not the first time CME Silver experienced a liquidity breakdown. It happened in early 2021 when the Reddit-driven short squeeze pushed silver briefly above $30 and spreads blew out to levels that prevented retail execution. It happened again in March 2022 when the Russia-Ukraine conflict triggered safe haven buying and the futures market gapped overnight by 7% with no continuous trading. It happened again in October 2023 when Middle East tensions sparked a flight to hard assets and market makers widened spreads to levels that made hedging uneconomical for dealers. Each event was treated as an isolated incident. Each event was followed by assurances that risk management protocols had been reviewed and that the market structure remained sound. The assurances were not false. They were incomplete. The market structure is sound for handling normal volatility within normal participation patterns. It is not sound for handling the participation pattern that is now emerging, where a significant and growing percentage of market participants are demanding physical delivery rather than closing positions for cash. That demand pattern was not part of the original design assumptions. The design assumed that physical delivery would remain a niche use case, that the vast majority of participants would use the contract for price exposure and hedging, and that the small percentage demanding delivery could be satisfied from the existing inventory buffer without stressing the system. The assumption was reasonable when it was made. It is obsolete now. The participants demanding delivery are no longer a small niche. They are institutions with billions in assets under management, sovereign wealth funds executing strategic commodity accumulation programs, and family offices that have decided synthetic exposure is unacceptable. These participants are not trading, they are acquiring. They are not closing positions, they are taking delivery. They are not providing liquidity, they are consuming it. The market was not built for them. It was built for traders who provide two-sided flow, speculators who add liquidity through contrarian positioning, and hedgers who use the contract to offset physical exposure in the opposite direction. When the participant mix shifts from traders to acquirers, the market loses its liquidity foundation. Acquirers only buy, they do not sell. Their demand is unidirectional. Unidirectional demand in a market that depends on two-sided flow creates the kind of liquidity void that appeared when silver tested $100. The void will reappear every time price approaches a psychologically significant level, because those levels attract the attention of acquirers who have been waiting for confirmation that the bull market is real before committing capital. The confirmation comes in the form of price breaking through round numbers. $100 is a round number. It is also a level that triggers algorithmic systems, media coverage, and retail FOMO. All three forces add to unidirectional buying pressure. All three forces drain liquidity. The next significant level is $125. If silver reaches that level, the liquidity failure at $100 will repeat at larger scale because the participant base will have expanded to include retail buyers who were priced out at $100, but will stretch to participate at $125 out of fear of being left behind. The cycle will repeat at $150, at $200, and at every subsequent round number until either supply increases enough to satisfy demand or price rises high enough to destroy demand. Neither outcome is imminent. Supply is constrained by mine production timelines, refining capacity limits, and recycling infrastructure that cannot scale quickly. Demand is being driven by monetary system distrust, currency debasement fears, and institutional reallocation away from financial assets toward hard assets. Those drivers are not price sensitive in the short term. They are structural. They persist regardless of whether silver is at $100 or $150 because the decision to acquire physical metal is not a trade based on price charts. It is a portfolio decision based on risk assessment. The risk being assessed is the risk that paper claims will not be honored, that currency will lose purchasing power faster than official inflation metrics indicate, and that financial system complexity has created fragilities that are not visible until stress events expose them. The liquidity failure at $100 was a stress event. It exposed a fragility. The fragility is that the paper-silver market cannot handle sustained physical offtake at scale. The exposure of that fragility does not reduce demand for physical metal. It increases demand because it confirms the concerns that were driving demand in the first place. The confirmation creates a reflexive loop. Demand drives price higher. Higher prices expose system fragilities. Exposed fragilities increase demand. Increased demand drives prices higher. The loop continues until something breaks the cycle. The break will come from either a supply response that satisfies demand, a price level that destroys demand, or a system intervention that changes the rules. The supply response is not coming in the near term. The price level that destroys institutional demand is unknown, but certainly higher than current levels. The system intervention is the most likely outcome. The intervention will take the form of rule changes that limit delivery rights, expand cash settlement options, or introduce capital controls that restrict physical metal purchases above certain thresholds. The groundwork for such interventions is already being laid through incremental margin increases, eligibility expansions, and emergency protocol activations. Each incremental change is small enough to avoid triggering panic. Each change moves the system closer to a structure where physical delivery becomes prohibitively expensive or administratively restricted. The restrictions will be framed as necessary for market stability. They will be implemented during moments of acute stress when opposition is limited because participants are focused on managing their own positions rather than challenging exchange policy. The unanswered question is whether the restrictions will be implemented before or after a delivery default forces them. A default happens when the exchange cannot source metal to satisfy delivery demands and must either break contracts or change terms retroactively. That outcome would destroy trust in commodity futures markets broadly and trigger capital flight toward assets that cannot be administratively altered. The timeline to that outcome is no longer theoretical. The registered inventory is declining. The delivery rate is rising. The gap is closing. Something gives within 12 months. The market snapped at 100. What breaks next determines everything.